Welcome back to Fast Money. A new administration, the specter of inflation and a hawkish Fed may have major implications for credit markets this year. But our next guest says any potential uncertainty could be a huge opportunity. Armin Panosian is the co-CEO of Oak Tree Capital Management. Welcome back. Great to see you again this year.
Good to see you too.
iConnections. Why is that?
Well, anytime there's uncertainty, it creates opportunity for firms that have the depth of expertise and finding that type of idiosyncratic situation that needs a solution. So we're really excited about the uncertainty. We think there's opportunity embedded in it. But in addition, I think because there's some uncertainty around the inflationary policies that President Trump may be taking on, kind of leans on rates being higher for a little bit longer, which is great for credit investors.
Right. Where are we? I mean, are we in a sweet spot right now in terms of rates for the private credit markets? I mean, we just had Elizabeth Burton of Goldman Sachs, and she was saying it's actually better if rates are a little bit lower. You know, your borrowers can pay back better.
Sure. I think there are different types of borrowers. So in terms of consumer borrowers who are below prime or subprime, I think the rates are kind of tough right now. We are seeing some elevated delinquencies in that type of borrower base. But in terms of corporate borrowers, fixed rate borrowers, this last few years have been a pretty good period for them because they've been able to grow with inflation and some of the stimulus. So they're actually feeling really good about life.
I'm sorry, I was just saying something's happened that's never happened before since September. 10-year yields 3.6, Fed cuts goes up to 4.8 over the course of 5 or 6 months. We've never seen that before. Yeah. Is there a threshold where, you know, rates get to 5%? That's been the number that's been talked about. Things start to get a little dicey in your world.
They do. And I think it's really because there are certain types of assets that are pegged to that 10-year, especially in real estate. I don't know what the magic is on 5%, but it does feel like there is an issue that will become a problem if 5% is the persistent rate on the long end of the curve.
Armin, you said higher for maybe a little longer. So we hear higher for longer as kind of a mantra here. You know, we're at 4.5 in the 10-year. If you had to look out, I don't know if you're a betting man or not. Look out 6 months. Are we 5% or are we 4% in the 10-year?
If I were a betting man, I would say closer to 5%. There's a lot of deficit spending that is planned. That leans on the rates being a little bit higher. We need to be a bigger borrower as a country. But for some pretty significant changes in the buyer base of our treasuries, I think it leans on higher rates.
In terms of private credit, here at iConnections, obviously, you're talking to a lot of potential investors. What are the biggest drivers still driving them to the private credit market as another layer of investment? And what role do treasury yields play in that decision in terms of carving out your basket and deciding within my fixed income basket, within my, bond basket, I'm going to go to private credit over something else?
Yeah, it's a great time to be in credit. It's partially due to the rates being high. It's also partially due to some pretty attractive spreads above those base rates. When you compare that against equities, I think the prospective returns on credit are far more attractive because there's a contractual rate of return. The coupon is very powerful. If you look at the forward PEs today and you were to overlay them against history and kind of do a little bit of prediction on what equity markets would return, we think that they'd be inferior to credit in the short to medium term. And that's why a lot of investors are looking at credit because of that contractual return, because the picture for equities is a little bit uncertain. And that's why they're allocating. But in addition to that, they just like the income. I mean, high yield bonds yielding 7%, broadly syndicated loans yielding even more than that, private credit close to 10%. If you're a pension fund that has a roughly 7% payout ratio, it feels really good to be in that sweet spot of credit, of below investment grade credit.